Welcome to TheoTrade. This is Don Kaufman here doing the weekend update. It is February 24th, 2017. First, let's talk a little bit about this past week. Then we're going to be very forward-looking, look at some trade setups, talk about some implied volatility, and really some opportunities in kind of the week to come. Let's start with the SPX. As I often do, the marketplace this Friday closed here at 23.67. So where did we ultimately start this shortened and holiday week? So for that, I'm going to go over here on thinkorswim to the Analyze tab. And I'm looking back, and for those of you, again, if you want to see the calendar, again, Monday was the holiday. So I'm actually going to drop back to Monday and look out at the week. And what I'm actually doing over here, and I'll go ahead and close up this left side bar to make it a little easier to understand, is just kind of like the week in review. And that is, the week ultimately started with the SPX at 23.51. Now, we just mentioned it closed the week basically at 23.67. So what was the week really expecting? Meaning that the option markets, what did the option markets say about price action this week? And that's, again, this is, I'm going back, back in time to look forward. And for the most part, we were expecting, no more than about a 21-point move on the week. And where are we? Well, really not that far off. Now, you have to recognize these expected moves. They're not saying we're going to move 21 points higher or lower. Okay? They're saying we're likely to stay in that range approximately 68% of the time. But as I've noted many, many times, we're staying in, this deviation. And this is, again, right over here, this is a one deviation. And it's roughly plus 21 or minus 21 from the current point, which is 23.51. Now, we're supposed to be in this range approximately 68% of the time, but really we're in the upper 80 percentile right now that we've actually been in this one deviation range. Okay, so that doesn't necessarily mean run out and sell options premium, because when we do move outside of this range, we've been moving way out here in 3 deviation territory, right? I know I'm starting off, I'm geeking out early on this, but it's important because once again, here we are on a Friday and we're, just a few points off it. You got to realize this is a $2,367 product and it misses its, target of expected move. We're like, okay, it was supposed to be up 21 bucks. Oh, I'm sorry. We only missed it by $4. I mean, again, it's insane how effective these expected moves have been. And yet still, there's just not enough talk about this in the retail trading world. Okay, so that's where I wanted to start. In terms of like a review, hey, I'll tell you what, today's trading session, I got to speak specifically about Friday over here. Today's trading session started off with a little bit of bang. We even touched down to this, the infamous 23.49 level, just prior to the cash open. And pretty much after the cash open, pretty much up in smoke over here, we started rallying. By the way, what would up in smoke is my hopes, my dreams. Hey, one day we're going to actually sell off. But there were some signs of some volatility emerging. And to look at some individual stocks, maybe we'll deviate from the S&Ps for a second. Look at an individual stock. You want to see some signs of volatility? Amazon was rocking here at the cash open to the point it traded all the way down to 837 and change. And the option markets went to what they call fast markets. The bid offer spreads were triple what they typically are in there. We haven't seen this kind of action really in many stocks, and no news about it, nothing out there. Amazon, though, again, was taking a hit, rallied back up throughout the course of the day. Some of the volatility kind of mellowed out. Now, there's one area, that remained soft throughout the course of the trading day. And we're going to talk pretty extensively here about the XLF and the bonds. So bear with me for a moment. The XLF comes off again pretty hard. Looks like a little bit of a mistick over here, but the XLF comes hard, right at the cash open. That is, it dropped from the previous day's close. And I like to sometimes show this after hours trade because you can see there's a gap print down at the cash open. XLF doesn't budge. In fact, even when the rest of the market was rallying to the close, the XLF picked up a couple of pennies over here, but it unto itself, like looking at the XLF, this is actually what held back the S&Ps from a broader rally. Okay. What's shocking to me, though, is if you take a look at the XLF, which is it's the financial sector, right? It's the most interest rate sensitive products out there. Doesn't seem to make sense, though, looking at the bonds. The bonds, okay, for the last, 2 weeks of trade, and again, we have 1, 2, 3, 4, 5, 6, 7, almost a full 2 weeks of trade over here, have ripped higher. I mean, the bonds today were actually cresting again at one portion right up into the 153 handle. Here we are, though, 152. And again, the contract is rolling forward. I don't want to confuse anybody with this, but we're at the 152 level inside of the bonds, which we haven't been to in quite some time over here. Again, why are the bonds rallying? And it's not having the broader impact to the XLF. The XLF was actually rallying with the bonds. Quite curious. Now, I'm going to back up for just a second over here before we go any further. Okay, talking about the XLF and the bonds. I want you to look at the SPX. Forget about the chart because, well, we were down here and now we're up here. Okay, enough said. Some point we're overbought, but it doesn't matter. Like when I say it doesn't matter, like nobody cares that we're overbought. Whether you want to look at an RSI, a stochastic, I mean, hey, to your heart's content, nothing matters in overbought territory over here, not fundamentals, not technicals, but I want to give you a read on implied volatility for the week to come. So we have options next week. Here's like the 3-day options. What's a 3-day option? It's an option that expires on Monday. Okay. We've also got, again, this is a Tuesday expiration because it's an end of month option. Now, I've said this before in some of these weekend updates. I've been doing this a long time. I've never seen implied volatilities this low. Like, look at this. 5.11% volatility. That's less than a $10 expected move. That includes all of Monday's trading session. So it includes this weekend as well. Like, hey, nothing can possibly happen. There can't be, a crazy tweet over the weekend. Nothing can possibly happen is what's being priced in. This is like the VIX dropping down to 5%. Then into Tuesday, okay, we're looking at a 6.63 vol on a $14 expected move. So all throughout, all through Tuesday, we're still only expecting a $14 move. Now, where things start to get a bit more interesting, and this is going to be important in this coming week, the March 1st expiration, you'll notice the bump in volatility is only about 1 point. Again, I want to elaborate on this for a second. Why? Okay. There's a lot of traders that were talking today. I mean, I'm constantly talking to traders throughout the course of the day, and it's, traders that sit on desks at some big firms out there. One of my friends at a volatility arbitrage firm, and all of us are talking about the exact same thing. We're like, how can the 5-day expiration, which is the March 1st options in the SPX, how could they only be sitting at a 7.68 vol? We all recognize there's a big speech coming on Tuesday night. Well, maybe people don't recognize it. It's not called the State of the Union address. Okay, presidential first term. It's basically just he's speaking to Congress. Is nothing going to come out of that? Is absolutely. I mean, what are your expectations? All of us were talking about this. We're like, we can't believe implied volatility is this low. So one thing, okay, that I've thought long and hard about, the volatility is going to elevate early next week. All right. So the volatility is going to elevate early next week. And I'm looking at the idea, okay, as crazy as it sounds, I want to be a net buyer of premium next week. Okay. I'm going to look to, buy straddle, buy strangle, or buy an iron condor. I do not want to be short options next week. No way, no how. Volatility is so rock bottom over here, and you do have some major news possibly coming out. And again, you just, the policies and so forth and policy shifts, you have no clue. Okay. And does this look like a market that's trying to price in, uncertainty in? Absolutely not. It looks like the most certain market in the entire world. I'm going to show you a little bit more about this. So expect volatility to expand as the week progresses. The entire trading week next week, all right, is only expecting about a $23 expected move, which is, listen, that's no different than we saw this past week and the week before that and the week before that. I mean, I got to go all the way into December to see expected moves that are higher than $23. And the irony is we've stayed inside of the expected range week in and week out. Okay, so why go out there and, buy the straddle, buy the strangle? Because eventually, instead of moving $23, we're going to move $100. And that's why right now, it's plain and simple. I want to buy options, but I don't want to expose myself, okay, to drastic risk. And to do that, I have to actually buy shorter duration options. And people get this confused. Like, I want to buy longer duration because the options don't decay as fast. Yes, but the options, if you buy them further out in time, they don't have enough gamma to make it worth your while. Now, I'm going to switch gears a little bit, right? So now we're talking about risk next week. Well, let's continue the idea with risk. One of the other things, I've been throwing around this idea over here. So the bonds are getting bid up the last 7 trading sessions. What do they see? When I say the bonds are getting bid higher, what do they see? Okay, go take a look at the TNX. The TNX is the 10-year. The interest rates are falling right now. Okay, and anytime I see interest rates falling, which is directly connected to bonds or notes, all right, and the bonds bid, I always think to myself, somebody knows something about risk over here. This really appears to me to be like duck and cover. They're buying bonds because they're trying to avoid risk. Now, there's heavier volume in the bonds. Discount this completely. The heavier volume in the bonds is exclusively because there's a bond roll going on. That is, they're rolling from one expiration to another. Now, nevertheless, the bonds, they are being bid much higher over here. Okay, so the bonds alone, that doesn't necessarily make me too nervous. All right, so the bonds are kind of, yeehaw, they're getting bid up. Yeah, well, the bonds and gold. So now I've got 2 risk metrics. And if you look at the bonds and you look at gold, forget about the VIX, because the VIX is lying dead on the floor. I mean, literally draw a chalk line around it, because somebody's going to have to go over and kick the VIX the next time the market is really ready to sell off. The VIX is going to be the last guy on the street to know. But you got bonds and you got gold. And gold isn't just bid higher. Gold is actually now at where it was ultimately in a defensive stance before the election. And it's a little disconcerting. All right, so now we got bonds up. We've got, gold up over there. Now, the dollar, the interesting thing is the dollar has actually rallied recently and gold has rallied. Okay, now none of the other risk metrics that I look at are heavily elevated. Like the VVIX, it had a pretty good range today, but it's not per se elevated out there. The only thing I can point to that's elevated in terms of a risk metric would actually be what's called skew. And I've talked about this pretty much, at depth, but the skew out there, what it does is just measures the out of the money puts versus the out of the money calls, but it's been elevated for a period of time. But we do have a multitude of risk metrics that are elevated. Now, I'm actually going to show you some other areas and I think some opportunities in the marketplace. Okay. First and foremost, let's again switch gears a little bit. So we're coming into next week. We know that we've got risk midweek, right? We know that the volatility is likely to expand out. It's one of the opportunities out there. We know that the XLF hasn't been reacting like we believe it should. Okay, how do we believe the XLF should react? Well, I'll tell you what, okay? At the very least, and I'm going to pull up, this is just the implied volatility. At the very least, you would see implied volatility really start to pick up. Again, we have the bonds rallying and it's not impacting the financials. It's like volatility is just shrugging it off. No, there's no bad news. No, nothing to see there. I mean, there's like this monster in your face and you're like, no, I don't see it. I'm going to pull the sheet above my head. It's okay. I don't see it. And that's kind of the way I feel about the XLF. But I'm going to show you something even crazier. Go take a look right now at the XLE. If you're not familiar with the XLE, it's the energy sector. The energy sector has been slipping pretty hard lately. Again, off the 78 level down into the 70 handle. Now, I do want to just mention, I carry a position in the XLE. I happen to be short the XLE, a few hundred shares over here. It's moving my direction, but that's neither here nor there. The disconcerting part is you got a product that's falling pretty hard over here. The volatility, it's like it doesn't even see it. And I'll show you one of the biggest components of the XLE. If you're not into the XLE, go look at ExxonMobil. Okay. Now, this is a 1-year chart on ExxonMobil. Pretty much falling out of bed after earnings, not getting any better. Take a look at the implied volatility, though, out there. It's pretty much lying dead on the floor at this point. In fact, you can even pull up like a 5-year weekly. It's one of the lowest implied volatilities we've seen on ExxonMobil. But the irony of the entire situation is other times when ExxonMobil, has been under stress, the stock has actually shown, again, the implied volatility in the options has picked up. And again, when you're seeing, ExxonMobil pretty much falling out of bed over here and bottoming out at times, the implied volatility really started to pick up. Now, it is an energy stock, and there are times when the implied volatility can actually get completely inverted over here. But again, got to watch a few of these stocks very, very carefully as they're major components. Again, the Dow, all right, the S&P 500, and carry huge market cap out there. But we're looking at implied volatilities that are literally lying dead on the floor. I'll give you another example of just this. So stocks that are in sell side activity with dead implied volatility. Oh, here's a nice fun one. Pull up Twitter. Now, if you're thinking about this and you're looking at Twitter, you're like, I'm not exactly sure what he's showing me. The implied volatility is the lowest level that it's been any time in the last 52 weeks. In fact, if you're into implied volatility percentiles, the percentile is 0. But the strange thing, and I'm seeing this on a lot of stocks, these stocks are getting clocked to the downside. Now, granted, earnings came out. They're getting clocked to the downside on falling implied volatility. And I've seen some backward things over my years, but stocks, usually they're getting crushed, don't typically have risk metric, which is their implied volatilities, falling. First and foremost, like if you're looking for an opportunity inside of Twitter, the interesting, trade to me in Twitter is you're like, well, it's going to keep falling. Well, if you think it's going to keep falling, all right, it's one of the few times you can go out there and just buy some puts. I mean, they're dirt cheap. They're absolutely dirt cheap. And I never want to go out and buy options. But the other irony is, a lot of traders are going to want to go out and they're going to want to buy calls, in the idea that the stock could be taken over in Twitter. And again, I never just go out there and buy puts or buy calls over here. But the likes of Twitter, not a half bad idea. Now, I'm going to set it up another idea for you that I'm going to build, sometime late next week. So here's the other idea I have for you. Why don't you take a quick glance over at Walmart. Forget about implied volatility for just a second. We're just going to look at the Walmart chart. Walmart absolutely exploding from the 65 level to 72.5 over here. Look at it versus Target. Target just getting crushed and pretty much staying down, lying on the mat. Now, Target is going to have earnings on Tuesday. After Target's earnings, right? Regardless of what they are, we're going to look to put on a pairs trade. Now, we're probably going to be long Target, short Walmart in this particular pairs trade, but I want to let the earnings volatility play out prior to doing so. Again, we are actually looking at a long Target, short Walmart, and I want you guys to be thinking about this one in kind of the coming week, and I'm going to look to execute probably around Thursday or Friday. Again, let some of the volatility play out from the earnings, and ultimately, let's see what Target does. In effect, it would be the most effective if Target got crushed on its earnings and we can actually set the trade up. So again, keep your head up this week. There's a lot of opportunities out there, and if some of the stuff I'm covering, it feels a little bit complex, don't worry about it. Just join us anytime here at TheoTrade. Repetition, that's what this learning curve is about. I threw a lot of different things at you, from implied volatilities over here to a couple of setups from like pairs trading, a volatility setup in the SPX. Again, you have this opportunity where nobody's pricing any risk whatsoever into this week of trade. A $23 expected move in the SPX for the entire week seems inordinately low, given, again, some of the risks out there. And you just want to, kick the market over there. Wake up, There's a monster staring at you. And yet, 4 days out from now, we have a 6.63% volatility. Think about it over this weekend. I want to thank everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.